Preface. Man learned to invest a long time ago, but investment banking has a relatively short history. It wasn't until the Dutch East India Company, VOC, started issuing bonds and shares of stock to the general public that investment banking saw the light of the day. But since then, the services provided by investment banks has grown exponentially, and it is today considered to be one of the most lucrative segments of financial institutions. Investment banking is different from commercial or retail banks in the fact that they do not take deposits. But this is not the only difference. There are other things that make investment banking unlike any other form of banking. There are a number of functions performed by investment banks. Investment bankers in the US must be a licensed broker-dealer, and they must follow the rules and regulations laid down by the Securities and Exchange Commission, SEC, and Financial Industry Regulatory Authority, FINRA. Knowing the history of investment banking, the manner in which it has evolved over the period of time, and the different services that it offers can help anyone who wants to be an investment banker or who is interested in investment banking. Introduction. Investment banking is a particular banking division which deals with the creation of capital for other companies, governments, and entities. These services are rendered by investment banks which specialize in large and complex financial transactions. These transactions include underwriting new debt and equity securities for corporations. They also help in the sale of securities and assist in mergers and acquisitions. The top 10 investment banks in terms of advisory fees for the year 2016 are: first, J.P. Morgan & Company. Second, Goldman Sachs. Third, Bank of America Merrill Lynch. Fourth, Morgan Stanley. Fifth, Citigroup. Sixth, Barclays Investment Bank. Seventh, Credit Suisse. Eighth, Deutsche Bank. Ninth, Wells Fargo Securities. 10th, RBC Capital Markets. Some investment banks focus on specific sectors of the economy or on particular industries only. The income of investment banks relies on various factors. The advisory division of these banks earn through the advisory fees, while the trading section of the bank earns profits or losses based on market performance. An investment banker can be working as an advisor, a salesperson, or a trader. Being an investment banker is considered to be a great career, but those who are a part of the industry usually explain that it comes with a substantial amount of stress. The role of investment banks starts with counseling the corporations before underwriting the debts, and from there onwards the bank continues to advise the corporations after the sale of the securities. Investment banking often involves the examination of a company's financial statements in order to ensure accuracy of the details before it publishes a prospectus which can explain the offering to investors. This is done before the securities are put on the market for the investors. An investment bank functions as a financial intermediary and in its capacity as a middleman between the company and its investors. It assists by putting a price on the financial instruments to help in the maximization of revenue and to ensure that all regulatory requirements are met effectively. Usually, when a company holds its initial public offering, IPO, an investment bank may end up buying all the shares directly from the company, and then it works as a proxy for the company and sells the shares in the market. The company gains from this transaction because it does not have to worry about selling the shares itself. Instead, the IPO is contracted out to the investment bank. The investment bank stands at an advantage here because it usually makes those shares available in the market at a price higher than what it initially paid for the shares. It does involve a certain degree of risk, which is where the analysts at the investment bank come into play. They make sure that the shares are priced appropriately to make enough profit and ensure that the shares are sold. Overvaluing the shares can be a problem, since it may lead to lower sale of the shares, which can eventually cause a loss for the bank. When a company announces its IPO, investment banks compete with each other to secure the IPO. Sometimes this may mean that they will increase the price at which they buy the share, or the company may end up contracting the IPO to more than one investment bank. In a case where banks raise their prices, it can be difficult for them to gain adequately from the subsequent sales of the shares. On the other hand, when the IPO is contracted to more than one bank, the risk is shared and each bank has to worry less about the risk. Lesson 1. The history of investment banking. With global trade and capital on the rise, investment banking is one of those sections of the financial industry which inspires a lot of awe. This is nothing new, because investment banking has always been intriguing right from its conception. The first company that issued bonds and shares of stock to the general public was the Dutch East India Company, VOC. It created history in more ways than one, becoming the first company that was listed on the stock exchange and so the first one to be a publicly traded company. Today's investment banking practices are largely inspired by the rules laid down by the Dutch. Early investment banking services were limited to underwriting and overlooking mergers and acquisitions, but over the last few decades it has changed massively into a section of the financial industry which offers a wide spectrum of services including securities research, proprietary trading and investment management. In the United States, modern American investment banking was introduced by J. Cook, who was a Philadelphia-based financier during the Civil War period. Investment banking already existed in the US through private banks, but the evolution of investment banks largely happened after the Civil War. At the time of the Civil War, the federal government required money to fund its war efforts. This is when J. Cook convinced the idea of selling securities to the masses. He employed thousands of salesmen who sold $830 million worth of government bonds to a large group of investors. To further the efforts of funding the war, Cook reached out to the public himself in the capacity of an agent of the Treasury Department, and he headed a war bond drive, which subsequently helped the government put together $1.5 billion for the Treasury. The 19th century also witnessed the birth of investment banks like J.P. Morgan and Goldman Sachs. These early years of investment banking in the United States lasted till the Great Depression. Investment banks flourished during the 19th century and the early 20th century, and the period is often known to be the golden age for investment banking. Things changed when excessive market speculation and unsustainable surges in stock prices led to the market crash of 1929. This marked the beginning of the Great Depression, which was an extremely difficult time for investment banks. To survive the period, some banks merged, while others converted into commercial banks. Since desperate times call for desperate measures, the industry resorted to applying the Glass-Steagall Act in 1933. This act required investment banks to be separate from commercial banks. While many banks were forced to convert to commercial banks, others, who could manage, ended up creating a separate division for investment banking. J.P. Morgan established its securities underwriting division, which was named Morgan Stanley & Company. The period of Great Depression also saw the emergence of the rule that investment bankers should be separated from brokerage services to make sure that the bank provides fair and unbiased services. There was a possibility that the bank ends up selling overvalued securities to its clients in order to gain the trust of the client company. As the Depression slowly started to lift, investment banks started seeing opportunities in new ways. They started gaining by being advisors to companies that were going through mergers or acquisitions. During the 1980s, trading became popular in investment banks, and the banks were able to leverage the power of the computers to create robust trading strategies which could help them earn profits. With the dot-com boom in the 1990s, investment banks continued to be on the gaining side, and in 1999, the Glass-Steagall Act was finally repealed. Investment banks faced a second blow during the financial crisis of 2008. Some banks were merged or acquired by others, but the result of the financial crisis is felt till this day. Wall Street's position weakened during this time, and new financial centres are now on the rise. Singapore and Hong Kong have gained higher grounds as they take advantage of the economic progress in China and the Southeast Asian countries. Over decades of success and failures, investment banks have been able to build an image that inspires admiration. Since the time of the last financial crisis, investment banks are beginning to gain the trust of the general public once again, and if history repeats itself, another golden period may be around the corner. Lesson 2. Role of investment banks. Investment banks exist to bridge the gap between large enterprises and investors. They function as an advisor helping organizations and governments with solutions on how they can meet their financial requirements and to assist in the procurement of such finances. These solutions may include anything from the issuance of stocks or bonds to other derivative products. Most large enterprises do not want to fall into the whole task of doing this themselves. Financial transactions of such large scale require a substantial amount of expertise in the field of finances. Everything from pricing the financial instruments to maximizing the revenue comes with a risk. Investment banks, with their acumen, are able to help large enterprises in such situations. Advisory services. When a company or a government decides to raise capital, it looks for help from investment banks in order to find the best way to meet their financial challenges. There are globally famous investment banks and boutique banks which can help companies and government take sound financial decisions. An investment bank looks at a number of factors, like the present market conditions, before they advise the company on the ways in which capital can be raised to maximize revenue. Investment banks also help organizations in pricing the financial instruments with the help of complex business models. When the company decides to go with stock offerings, then the investment firm will have analysts go through details of the company, which include its earning potential and the robustness of its leadership team. This helps them estimate the worth of each share of the company. On the other hand, if bonds were being offered by the client company, then the bank's analysts will check the current interest rates for businesses of the same nature and stature in order to estimate the amount that is required to compensate the borrower. Advice, however, doesn't just end with providing solutions for financial challenges. Investment banks also offer assistance when companies are going through a merger or an acquisition. Companies that are planning to buy another entity can get advice from the investment bank regarding the profitability of such a deal. Underwriting stocks and bonds. When an organization decides to meet their financial requirements by making an equity or debt offering, then investment banks have the opportunity of underwriting the securities. When a company holds an initial public offering, one or more investment banks make an offer to buy all or part of the shares. If a bank buys all the shares, then it is the sole underwriter of the issue, and it can then price the shares to gain adequate profits. Sometimes the company may sell the shares to more than one investment banks. This is less risky for the investment bank. Companies look for the best offer that can be made by the investment banks which are interested in buying the shares. In an attempt to outbid their competitors, bank may have to buy the shares at a higher price. This reduces the overall amount of profits they can earn out of the transaction. Sometimes, banks may even experience a loss. This happens when the shares are sold at a lower cost than the cost at which the investment bank bought it. If the public is unwilling to pay the amount at which the shares are priced by the bank, the investment bank has to lower the price, which can reduce the profit or may even incur losses for the investment firm in order to liquidate its holdings. Most of the times, IPOs are issued to more than one banks. In some cases where the offering is very large, the managing underwriter may form a syndicate of banks who can sell part of the shares. This helps the investment bank reduce the amount of risk and liquidate the holdings easily. Investment banks also function to support companies in stock offerings. Their role here is to create all necessary documentation which is sent to the Securities and Exchange Commission before the shares are made available for the investors. It involves the compilation of financial statement, details related to the company's management and current ownership, as well as a statement which entails information about how the company will be utilizing the proceeds. Research. This function is often carried out by large investment banks who have a team of researchers and analysts who can gather information regarding the financial standing and management of the companies in order to make recommendations on whether it will be profitable to buy or sell the stocks of the company. These reports are generated by the investment banks to be used internally, but it can also use these details as a mode of income by selling such data to hedge fund managers or mutual fund managers. Even if the research is not used for generating revenue, the information gathered by the analysts is valuable for banks to guide investors and help them take the right investment decisions for better gains. The same information is also found helpful when assisting companies in the periods of the mergers or acquisitions. Investment management. Investment banks not only help in advising companies and underwriting securities, but also have a team of financial advisors who helps individuals, families, as well as corporations by providing advice regarding the purchase, management, and trading of different types of securities and assets. This section of the investment bank is usually divided further into two distinct areas, which are private wealth management and private client services. Trading and sales. A number of investment banks now have a trading department of their own, which deals with stock and bond transactions on behalf of their clients. Keeping in mind that this is an area where banks may end up conducting unfair business, a federal regulation known as the Volcker Rule has been put in place. According to this rule, banks are prohibited from conducting certain investment transactions with their own accounts. The regulation also limits the ownership of the investment banks related with hedge funds and private equity funds. This rule went into effect in April 2014, and banks were required to fully comply with the rule by July 21, 2015. The Volcker Rule was created in order to prevent banks from conducting unfair business or taking part in speculative investments, which had been a contributing factor in the 2008 financial crisis. Merchant banking. Often referred to as very personal banking, merchant banking involves the exchange of share ownership for capital instead of loans. This section of the investment bank usually also offers advice to the companies regarding the management and growth strategies. In the United Kingdom, merchant banking was the term used for investment banks for a long period of time. Famous investment banks of today like J.P. Morgan, Rothschilds, Barings and Warburgs were earlier merchant banks. Investment banking has now broadened its functionalities to include more services which can generate better profits and also help their clients in more ways. In most cases today, investment banks function as more than just an advisor or underwriter. While helping companies raise capital continues to remain a major part of their work, investment banks are exploring new ways in which they can provide their services to the clients. Some of this has led to criticism against investment banks as well. For example, the fact that investment banks were dealing with trading as well made investors wary whether the transactions were being conducted with a hidden objective that can cause losses for the investor but gains for the bank or its client's company. The more complex its functions become, the more chances of investment banking being criticized for the work it conducts. Some of its service offerings have been curbed by rules and regulations that encourage fair practices. No matter how much investment banks are criticized for their work, it is also important to remember that they play a pivotal role in assisting companies and governments take informed decisions regarding the financial requirements of the organization. The advisory role of investment banks is very important for companies in raising capital as well as during merger and acquisitions. The function of underwriting is also a very important one. Not only does the role of the bank help companies easily flow their shares, but it also reduces a lot of administrative work that the companies may otherwise have to conduct. Lesson 3. Organizational structure. Investment banks function through 3 main sections: the front office, middle office, and back office. Every section plays an important role in ensuring that the bank functions smoothly and it is able to run profitably. Most people feel that front office jobs are best, while back office jobs are thought of pejoratively. Everyone has their own perception of jobs, and everyone finds satisfaction in different careers. While the front office deals with the core investment banking functions, the back office functions to support the front and middle office teams. Front office. The front office is made of employees who directly face the clients. This is where the main income of the bank is generated. Investment banks broadly divide the front office into 2 main areas: investment banking and markets. While investment banking is the section that works as an advisor for organizations and governments in a wide range of fundraising strategies as well as during mergers and acquisitions, the markets section handles sales and trading, which also includes research to a certain extent. Investment banking. This is the traditional aspect of investment banking. It includes advising companies on how to meet their financial challenges and during mergers and acquisitions, M&A. Their work can consist of subscribing the investors to security issuance, coordinating with the bidders, and when required, even negotiating with the merger target. The bank puts together a pitch book which helps in marketing the bank to prospective clients of mergers and acquisitions. If the client's company finds the pitch to be lucrative, then the bank is employed by the company to help in the merger or acquisition. The bank then arranges the deal for the company. This segment of an investment bank is usually divided into 2 parts. There is the industry coverage group and the product coverage group. The industry coverage group is the division of investment banking which focuses on particular industries, which can include the healthcare industry, public finance, technology, media and telecommunications, power and energy, food and beverage, and corporate defense and governance. This section establishes and maintains relationships with various companies in these industries and helps in bringing business for the bank. Product coverage groups work to promote the financial products of the bank. This can include mergers and acquisitions, leveraged finance, structured finance, restricting, high-grade debt, public finance, and the like. They focus on the more intricate requirements of the industry groups and handle the specialized requirements of the clients. Sales and trading. One of the main functions of large investment banks is trading. Investment banks rely on trading for most of their revenue. Trading involves the buying and selling of financial instruments with the objective of monetary benefits from the transaction. The sales team of the investment bank calls institutional and high net worth investors and explain various trading options that can be profitable for the prospective clients. The sales team then send through the orders it takes to the trading division of the bank. The trading rooms then price and execute trades according to the requirements of the clients. Whenever needed, the trading team may even structure new products that can meet the unique requirements of specific customers. The structuring of new products is relatively new. It gained popularity as derivatives were introduced to the financial markets. Structures are usually highly technical and numerate employees who use their numerical abilities to create complex structured products which offer higher margins and returns than the underlying cash securities. Research. The research team is also part of the front office of investment banks. Investment banks have a research team in place to review various companies and identify the prospects with those companies. This involves writing reports regarding the review. These reports are then used by the bank to assist the investment banking division by reviewing the clients. It also supports the sales teams by helping them target the right clientele and ensuring that appropriate trading ideas are shared with the prospective customers. The trading teams also use the research information to create products that will be suitable for the current market situations. Some banks may even sell the research results to hedge or mutual fund managers and earn revenue through the research. Otherwise, the research is used for advisory purposes and to create robust strategies in the bank. Middle office. The middle office consists of 3 different divisions: corporate treasury, internal control, and internal corporate strategy. People in the middle office directly support the front office team. Investment bankers in the middle office work towards ensuring the overall financial healthiness of the institution. The corporate treasury division is made of a team of employees who are responsible for overseeing the funding, capital structure, and monitor the liquidity risk of the investment bank. Internal controls is the division responsible for tracking and analyzing the capital flow of the firm. This section of the investment bank plays the role of an advisor to the senior management of the bank regarding the measures that the firm should take to ensure profitability and the various businesses conducted by the investment bank through the trading desk. An internal corporate strategy division of the bank overlooks the management and profit strategy of the firm. These 3 divisions together work in sync with each other to make sure that the bank does not get into business relations or activities which can be detrimental for the financial health or reputation of the investment bank. The middle office is largely known to handle risk management for the investment bank. It goes through the market and credit risk, which the investment bank or the client takes onto their balance sheets when they conduct any transactions or trades. However, every job related to risk management or compliance may not rely by a part of the middle office. Sometimes such jobs can fall in the back office division if the person is placed far away from the trading floor and does not have any direct contact with the front office, then they will be a part of the back office division. Back office. As the name suggests, back office involves employees who work behind the scenes to ensure the smooth functioning of the bank. Back office employees work in settlements and make sure that the payments are processed in a timely manner. Human resources also comes around the back office team. The human resources section ensures that the bankers are paid and their performance is tracked, and they may be hired or fired by the HR team. The technology team is a part of the back office division too. Their job is to keep a check on the central systems. They may also be responsible for using technology to track employee conversations and ensure that the bankers do not indulge in forbidden activities. Some banks end up outscoring the back office functions. However, the job of back office employees is an extremely critical one. Lesson 4. The 2008 financial crisis and its effect on investment banking. The Great Depression had created a huge crisis in the banking sector, and the government, companies, as well as investment banks learned a lot from it. But history ended up repeating itself when the world experienced the financial crisis of 2008. It was the next big blow to the finance industry since the Great Depression. There were a number of factors that were responsible for the crisis, and the investment banks played a major role. Events that led to the crisis began when mortgage lenders started loaning money to house buyers and started looking for a way in which these loans can be taken off the books. This created an extremely complex market for mortgage-backed securities. In its early stage, the market took off pretty well and people were buying more of such securities, but that is when the tables began to turn. The securitization activities started gaining a lot of profits, and it turned many financial institutions hungry for more. The Wall Street bond traders began looking for more mortgages from lenders, which can allow them to create new securities that can in turn generate higher revenues for the firm and more bonus for themselves. The high demand for the securities made lenders devise mortgage loans that were riskier and more attractive. Even credit standards reduced, which opened lending services to people with lesser chances of making payments. The complex financial products being created by the lender flooded the financial system, and while the home prices continued to rise, the entire financial industry seemed to be riding the high tide. People who could not pay their loans had the option to refinance or sell their homes. The lenders didn't seem to find any threat with the products they were marketing. The problems arose when housing prices stopped rising and all of a sudden investors started rethinking their investments in mortgage-backed securities that were being created by Wall Street. The bubble burst and the entire market crumbled down, leading to the financial crisis of 2008. Lehman Brothers, one of the world's largest investment banks of the time, declared itself bankrupt, and this became symbolic to the intensity of the crisis. J.P. Morgan acquired Bear Stearns in March 2008, and Merrill Lynch was acquired by Bank of America. Credit Suisse was the best-performing bank in Europe during the crisis. Government loans helped rescue a number of investment banks. The banks were required to convert to traditional bank holding companies in order to access the loans throughout the Troubled Asset Relief Program, TARP. The financial crisis was an eye-opener for governments, companies and investment banks regarding the business model they followed. The absence of the Glass-Steagall Act was also scrutinized. When Robert Rubin, core chairman of Goldman Sachs, became a part of the Clinton administration, banks were deregulated. Even the rules that oversaw underwriting established companies and seeking long-term gains was altered, and the standards were lowered, with short-term profit being given importance. Even during the taxpayer-funded bank bailout, former Goldman Sachs top executives held high-level positions in the government and oversaw the distribution of funds. In the threat of subpoena, Goldman Sachs finally revealed that the firm had received $12.9 billion in taxpayer aid and $10 billion in the form of government aid. It paid $4.3 billion to 32 entities and $4.82 billion in bonuses. Morgan Stanley received $10 billion in the form of TARP relief, and it paid $4.475 billion in bonuses. The financial crisis of 2008 served as the beginning of a new set of reforms for investment banks. Regulations have tightened around their functions and focus on their core business has increased. Investment banking has experienced the following changes after the 2008 financial crisis. First, increased focus on core business. Many investment banks felt the impact of the financial crisis, and this is why they decided to reform their business model to focus more on their core business. Going back to do what they do best seemed sensible, and it has driven the energy levels of the front office teams as they get back to the core functions of an investment bank. Second, more effective regulations. The government and the finance industry realized that investment banking required to be regulated at a higher level. To accomplish this task, regulations like Dodd-Frank Wall Street Reform and Consumer Protection Act, which came into action in 2010, and Volcker Rule, which is a part of the Dodd-Frank legislation, came into existence. These have massively changed the manner in which investment banks function today. Third, global restructuring. Banks all over the world are going through transformations related to the structure of their business. Policymakers in countries around the world are enforcing regulations which prevent banks from taking part in activities that had led to the financial crisis. As a result, a number of banks feel that they are being limited in their functionalities. However, these regulations are also seen as a way of preventing the events which played a role in the financial crisis. Investment banks are responding to the new regulations by bringing the necessary changes and ensuring that all functions are carried out with clear and complete analysis of the amount of risk being taken by the bank and its impact on the economy. Lesson 5. Criticisms related to investment banking. Investment banking has often come under criticism because of a number of reasons. The fact that they have been at the heart of the two financial crises is one of the reasons why investment banks are criticized, but other reasons include a conflict of interest, very handsome pay scales, complicated nature of transaction that do not provide clarity. First, conflict of interests. Regulations require that banks impose a Chinese wall in the organization to ensure that the investment banking division is separated from the equity research and trading division. Critics claim that banks, however, do not maintain such a barrier. In acting as a bridge between an organization and the investor, investment banks must comply with certain ethics and rules to ensure that it conducts fair business. It must maintain independence and objectivity in all transactions conducted by the bank, and it should not allow anyone to act under pressure in order to approve certain documents or agree to certain products or practices. Most investment banks have an equity research unit where the research analysts start coverage of a company that can help develop profitable relationship of the bank with the company. Another area that draws a lot of attention from critics is the fact that investment banks are usually dealing with the trading of their own accounts as well. This means that the bank can be tempted to engage in front-running, which is an illegal practice where the bank executes orders for their own account prior to filling the orders that have been submitted by the customers. This helps the bank profit from the changes in prices that are created because of the orders. A conflict of interest can reduce the quality of information that is made available in a financial market, which in turn prevents the market from channeling funds to investment opportunities which are most beneficial. This reduces the overall efficiency of the financial market and the economy. Banks today are leaving technology to identify conflicts of interest and to curb such illegal activities. Second, compensation. Investment banking has always been known for the huge sums of money paid to its employees as compensation. The pay packages of investment bankers have been one of the reasons why investment banking, even after being criticized for its activities, is seen as a lucrative career opportunity. Investment banking is often seen as a stressful job, which often consumes a lot of time and requires the investment bankers to be very competitive and knowledgeable at all times. Keeping in mind that it is not an easy task to ask as an advisor to some of the Fortune 500 companies of the world, investment banking has continued to keep its pay packages lucrative enough even after all the criticism it receives from the media and the government. Certain reforms have created a transition of the pay packages of the higher management from an all-cash bonus to adding an equity component to it, but investment banks still boast of being some of the best paymasters in the market. Conclusion. The evolution of investment banks has been a relatively quick one. Investment banking has experienced a number of rise and falls in less than a century and a half. It continues to learn from the mistakes made in the past and improvises on its current offerings. The amounts of money that investment banks can make through the information they have access to often give them the chance to indulge in illegal practices. To curb such activities, the government and the industry has put a number of regulations in place, but the opacity of investment banks is yet to end. The Great Depression was a time of great measures, which included the Glass-Steagall Act. Investment banks found themselves very limited during the period, but they still ensured that they were able to conduct profitable business. The investment banking world celebrated greatly when the Act was repealed in 1999. The financial crisis of 2008 made the world realize the importance of sterner measures around the business model of investment banks. New rules and legislation came into act, and many criticized that the resulting crisis provided that the Glass-Steagall Act was necessary. We must, however, remember that since the Act has been repealed, investment banking in the US has been able to grow and compete more effectively. Having an act like this forced on the banks, once again, can reduce their capability and may not keep them as competitive as other banks around the world. The Volcker Rule helps in bringing some form of regulation that can reduce illegal or fraudulent activities being conducted in investment banks. Major investment banks in the US are known to have done well even during the period of the financial crisis and acquired other banks that could not survive the downfall of the markets. Bulge bracket, which refers to the most profitable investment banks in the world, have remained in the top tier for a long period of time. They have dominated the markets and have provided advisory and banking services to major corporations around the world. The banks that generally come under the bulge bracket are Goldman Sachs, Morgan Stanley, JP Morgan, Citigroup, Barclays, Bank of America Merrill Lynch, Credit Suisse, Deutsche Bank and UBS. These institutions have indulged in the creation of many new financial products like mortgage-backed securities, credit default swaps, collateral debt obligations, carbon emission trading, and insurance-linked products. Bulge bracket banks have a strong presence in most of the regions of the world, and the financial markets recognize these names quickly and link them to solidarity. Investment banks are now recuperating from the last financial crisis, and while strict regulations are ensuring that the banks do not conduct unwanted business, if history repeats itself, there is a possibility that the investment banks may soon go through a new period of profitability.